After the blockbuster performance of the movie Dhurandhar, fans have been eagerly waiting for the release of its second part. Now, like this movie, Indian companies also posted a Dhurandhar turnaround in quarter 2. So, investors had been waiting to see if Q3 results would resume that momentum. Now, as we discussed in the previous edition of this video series, in Q2, revenue growth, profit growth, and margin expansion were all at their highest levels over the last 5 quarters. Another reason for the investor enthusiasm was the GST rate cuts in September 2025. Since Q3 was first full quarter post GST cuts, hopes were high around increased demand. So how have companies fared in Q3? Have they delivered yet another Dhurandhar quarter, or has the momentum stalled? We will find out the answer in this video. Hello and welcome to ET Money's YouTube channel. As our regular viewers are aware, every quarter we do a comprehensive analysis of corporate results so that you can know the underlying trends across market caps, sectors and stocks. This information can help you stay ahead in the market and realign your portfolio for the best outcomes. So here I am with the analysis of Q3 FY26 results. Now this video belongs to our playlist on result updates. You can watch our previous analysis, and to stay abreast of the upcoming ones, you can check it. The link is in the description. Okay, let's start by taking a look at the broad performance of the BSE 500 group of companies. Let's check the revenue growth, profit growth, and the change in operating margins for the ex-BFSI BSE 500 group of companies. Now, ex-BFI means that we have excluded banking, financial services, and insurance companies as they have a different business model. We will be discussing the performance of BFSI companies separately. Alright, first is revenue growth. On this front, it's positive news. The revenue growth has reached 9.7% year-on-year, which is the highest in the last 6 quarters. However, the PAT growth has dipped to 6.5%, which is the second lowest in last 6 quarters. Finally, coming to change in operating or EBIT margin. Operating margin grew by 67 basis points in Q3, which is the second best in last 6 quarters. Now, a prominent reason for a dip in margin expansion quarter on quarter is due to the adjustments related to the labor code. Overall, while momentum in revenue growth has retained, net profit growth has slowed. The degree of margin expansion remains satisfactory. Now, what explains the lower profit growth? Well, a fall in margin expansion vis-a-vis the previous quarter is one factor, but other P&L items have contributed to it too. Depreciation and tax have risen by 13% and 14% respectively. On the exceptional front, it's a net outflow of about 11,600 crores against an inflow of over 8,000 crores. Together, they have likely contributed to lower profit growth. But a rise in depreciation also indicates higher capex, which works well for future growth. So, while the bottom line growth disappoints, there are silver linings as well. Next, let's take a look at the numbers of BFSI or banking, financial services and insurance companies. At 8.3% year-on-year, the revenue growth of BFSI companies has staged a smart comeback in Q3. This suggests that the impact of RBI's rate cuts is getting absorbed in the financial system now. In the previous quarter, the income growth of financial companies had fallen to a multi-quarter low of just 1% year-on-year. Now, it's the second highest over the last 6 quarters. The profit growth in Q3 stands at 8.1%, which is higher than in the previous quarter. This indicates not just less stress, but also decent growth in finance companies in spite of being in a lower rate cycle. Overall, at the broad level, the performance appears to be quite good. Okay, let's now narrow our exercise down to companies across large, mid and small caps to see which market cap is doing well at the moment. But before that, here's something important. Many of you come here for the kind of mutual fund analysis you rarely see elsewhere, rolling returns, downside protection, and so on. But knowing how a fund behaves is one thing. Figuring out how to use that information in your investing decisions can be difficult because each of us have our own risk comfort and goals. That's exactly why we built ET Money Select. It's a personalized shortlist of funds that stand out from 2,000 plus mutual funds, and not just on returns, but also on how consistently they deliver them and how well they protect when markets fall. The list is personalized to your risk appetite and gives you funds for long, medium and short-term horizon. And for every fund, you get a simple note explaining how it invests and what drives its performance. plus an alert if the fund starts to dip or a better alternative is found. So do check it out. Again, we will check the three metrics: revenue growth, profit growth, and change in operating margins. For large caps, we have considered the BSE 100, for mid caps, the BSE 150 mid cap, and for small caps, the BSE 250 small cap indices. Now, in terms of revenue growth, all three market caps have performed well. However, mid and small caps have done especially well. Mid caps revenue growth stood at 12.7% year on year, which is the highest in the last 6 quarters. Small caps revenue growth of 11.2% year on year is also the highest in the last 6 quarters. However, large caps revenue growth of 8.4% year on year is lower than the previous quarter's 9.4%. Still, it's the second highest over the last 6 quarters. Now, as far as net profit growth is concerned, all three market caps have suffered. Large caps profit growth at 2.1% year on year is the second lowest over the last 6 quarters. So is the profit growth for mid caps at 8.3%. At 29% year on year, small caps have done well, and this rate of growth is the second best in the last 6 quarters. Okay, now let's take a look at operating or EBIT margins. Large cap companies' margin expanded by 61 basis points year on year, which is the second best over the last 6 quarters. However, mid cap suffered a blow on their margins, which shrank by 15 basis points year on year. That's the second worst contraction since Q2 FY25. But at a change of 129 basis points year on year, small caps have done quite well. Overall, a good showing by small caps suggests that growth tailwinds are quite broad-based. The disappointments on profit front is likely due to the companies getting into the capex mode to tap into future growth. Alright, let's next see which sectors are the forefront now and which are lagging behind. But before we do that, do subscribe to the channel if you aren't already a subscriber, and don't forget to press the bell icon so you never miss a video from us. Like last time, we examined the aggregate revenue and profit growth of companies from 20 non-BFSI sectors within the BSE 500. The sectors that stood out post Q3 are capital goods, hospitality, and logistics. These sectors have witnessed high revenue and profit growth over the last 4 quarters. But what has worked in their favor? Well, the capital goods sector has benefited from a revival in capex cycle, high government capex, and a strong order pipeline in renewable, defense, and data centers. The hospitality sector has been enjoying tailwinds due to robust demand originating from tourism, leisure travel, weddings, business events, etc. The logistics sector has been riding on the volume growth in automation, e-commerce, FMCG, pharma, and express services. Government initiatives like the National Logistics Policy and PM Gati Shakti have helped it too. Now, the sectors that have been found suffering post Q3 results include gas transmission, power, and textiles. These sectors have seen low or falling revenue and profit growth over the last 4 quarters. Gas transmission companies have suffered due to rising input gas costs. High depreciation has also brought their profits down. Power companies have struggled due to lower electricity demand and delays in transmission additions. Finally, the textile sector has borne the brunt of increased competition from Bangladesh and Vietnam, rising input cost, and the higher US tariffs, which have recently been reduced. But that's what also makes the textile sector a contra call. In the Union Budget for FY27, a number of announcements have been made for the textile sector. To know more about what makes the textile sector click and to find out 2 other hidden themes in the Union Budget FY27, you can watch a related video. The link is in the description. Okay, now this brings us to the last part of this video. To find out companies within the ex-BFSI BSE 500 with a positive growth momentum, we filtered out names whose quarterly revenue and profit growth year on year has been at least 10% for the last 4 quarters and whose operating margins have expanded in each of the last 4 quarters. This gives us a list of 19 stocks. Their names are on your screen. The companies that have reappeared from our Q2 FY26 results have been highlighted. From the healthcare space, there are 4 names: Apollo Hospitals, Caplin Point, Amcure Pharma, and Laurus Labs. From the tech space are Inventurus, PB Fintech, and Persistent Systems. The capital goods space has 3 players in the list: GE Vernova, Hitachi Energy, and Warri Energies. Chemicals, retailing, and electricals have 2 companies each. On the poor performance end, there is one ex-BFSI company whose sales and revenues have fallen in each of the last 4 quarters and those margins have contracted in each. It's Jindal SAW. Jindal SAW manufactures iron and steel pipes, tubes and related products, primarily for energy, water and industrial applications. The company has suffered from weak demand, lower volumes, high input cost and a wider sectoral downturn. On the BFSI side, there are 15 companies whose revenues and profits have grown by at least 10% in each of the last 4 quarters. Companies that have been highlighted have reappeared from our Q2 FY26 list. Among housing finance companies are Aadhar Housing, Aptus Value, Bajaj Housing, and Home First. 3 banks appear on the list: Bank of Maharashtra, City Union, and Indian Overseas Bank. From the asset management industry is HDFC AMC. MCX is an exchange and Choice International is a broker. There are 2 companies in the financial pocket whose revenues and profits have fallen in each of the last 4 quarters: IndusInd Bank and Manappuram Finance. Now, both these companies have been suffering due to the deteriorating asset quality in their microfinance portfolios, higher provisions, and contracting net interest margins amid slower loan growth. You can see this list and research the stocks further if you are interested in them. But do know that none of the stocks mentioned are a recommendation, so do your own due diligence. Now, if you are interested in financial details of these companies, you can find them on the ET Money website and app. Just type the name of the company in the search bar and get going. Alright, let's summarize the findings of the video in the concluding section. We started this video with a question: has the Dhurandhar performance of Indian companies continued in Q3? To a great extent, the answer to this question is yes. There is pain on the net profit front, but that doesn't appear to be due to operational reasons. It appears that companies have stepped up capex, which can lead to higher growth in the future. The revenue and profit growth of finance companies also appears to be on decent footing. Among market caps, mid-caps exhibit margin pressures, but large and small caps have done well. Overall, this performance suggests that equity markets may do well over the next few months. Among sectors, capital goods, hospitality, and logistics appear to be in favorable position, while gas transmission, power, and textiles are suffering. These sectors can be explored for momentum and value ideas. We also gave the list of 19 ex-BFSI and 15 BFSI companies that have been doing well over the last 4 quarters. You can research them further to pick promising stocks for your portfolio. And with this, I have come to the end of this video. I hope you found it useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.